Welcome. We'll get started shortly. Before we begin, here's how to earn continuing professional education credit for attending this session. There are no polling questions or attendance checks. Instead, you will demonstrate your knowledge by taking a brief multiple-choice quiz using the Earmark app. Visit earmark.app in your web browser. You can also download the mobile app by scanning the QR code on the screen. Log in, or if you're new, create your free account. Be sure to use a valid email address because that's where we'll send your course completion certificates. From the home screen, scroll down to find the course. You can also tap the magnifying glass icon to search for the course. Tap on the course artwork, then the Enroll button. On the Course tab, you'll find the recording and quiz questions. Complete the quiz to earn your CPE certificate. It takes us a few days to create the course on the app, so if you are attending this session live, please wait a few days. We'll email you a link to the course when it is ready. If you have questions or need help, email us at support@earmarkcpe.com. And now, on to the event.
Hi, my name is Joe the Sniff Newmar. I'm not only a corporate accountant with over 20 years of technical accounting and SEC reporting experience, but I also have a stand-up comedy side hustle. In fact, I recently released a clean stand-up comedy documentary movie at www.atcsniff.com. So with that, I'll start off with a joke. Did y'all hear about the butcher that accidentally sat on his meat grinder and got a little behind in his work? Wait a few more seconds for the laughter, the online laughter to subside, and here we go. Course overview. Purpose. The purpose of this course is to provide insights to accounting professionals as to how to project manage the SEC reporting process. And I'll demonstrate this with my approach to project managing my company's 2024 10K. This could enable some accounting professionals in attendance to, number one, upgrade their understanding so that they can take a bigger role in a relatively esteemed SEC reporting function, or two, apply the lessons learned to their areas of responsibility, as the concepts and techniques I'm going to present are applicable throughout corporate accounting. Slide 3, philosophy. SEC reporting is a learned skill. In drafting a 10K, SEC reporting professionals must tell a story. Now, the story must incorporate completeness in terms of describing all the major transactions and events, and compliance with the applicable GAAP and SEC rules, and materiality is a factor. But keep in mind that the foundation is the story, with everything else integrated into the story. This will make the 10K document read much better. If the foundation is the myriad of applicable GAAP and SEC rules, then the 10K document will be harder to read and subject to internal criticism. Now, I was thrown into leading the entire SEC reporting process with very little guidance in 2008. I was knowledgeable about GAAP and SEC rules, and I was knowledgeable about my company, and I also possessed decent writing skills. However, lack of awareness of how to project manage all the applicable work streams and lack of awareness on how to handle internal and external auditor review comments culminated in a rough start. However, once I had developed a predictive workflow management system, which I'll be describing today, my performance dramatically improved, and many of my own lessons learned can be easily assimilated by others, including Earmark podcast listeners. Objectives for project managing a 10K preparation. Clearly define and meet all filing deadlines, including not only the final submission to the Security and Exchange Commission, but also the internal deadlines on the multiple turns of the document. Comply with the applicable GAAP and SEC reporting disclosure rules. Effectively project manage the 10K process in terms of all the work streams. Prepare an internal request list that clearly outlines the specific information required from internal contributors and those deadlines, and give internal contributors plenty of lead time for requests. Identify the potential risks and mitigation strategies. There could be areas requiring incremental GAAP and SEC research. There also could be areas requiring more engagement with internal parties. Write clearly and concisely. effectively handle review comments throughout the multiple turns of the 10K, ensure accurate XBRL tagging, and if applicable, contribute to an effective disclosure committee meeting. Next slide. The next slide is spreadsheet validations. Now I'm going to introduce something that applies to all corporate accountants. SEC reporting professionals often must prepare Excel files that go into the 10K, and I have realized that there are 4 spreadsheet validations to ensure accuracy, which I utilize when applicable. Number 1 is a roll forward validation. An example of this is the prior month year-to-date plus current month month-to-date equals current month year-to-date, or the prior quarter year-to-date plus the current quarter quarter-to-date equals the current quarter year-to-date. So whenever that one's applicable, I always try to use a roll forward validation. The second type of validation I call an XBRL type validation. That's where numbers that should match are validated as matching. So for us, cash on our balance sheet should equal the ending cash on our cash flow statement. The third type of validation is a tie-out validation, where we verify totals against the source. And the fourth is a recalculation validation, where we check totals and subtotals with alternative formulas. So perhaps if you sum down to get a total, you would sum across. Now, if you use these validations when applicable, you're much more likely to attain accuracy. And I have had direct reports that have transitioned from error-prone to accurate once they mastered these 4 validations and used them when applicable. Trend analysis, the 5th validation. Trend analysis is a crucial tool for validating the reasonableness of our final calculations, particularly in the context of stock-based compensation and dilutive earnings per share. Now, our restricted stock awards at our company typically follow a 3-year vesting schedule, with each grant contributing to the dilutive share calculation for a minimum of 12 consecutive quarters, both year-to-date and quarter-to-date dilution. Now, generally, a grant's dilutive impact tends to increase over time. And this is because as the vesting period progresses, there's less average unrecognized compensation expense available to repurchase shares, often referred to as a treasury stock method. And the shares left over that couldn't be repurchased are your dilutive shares. Now, this predictable pattern serves as a valuable benchmark for each stock grant when scheduling out the trend. If I observe a 1, unexpected spike in dilution, or 2, sudden drop to 0, or 3, any other anomalous result, it immediately flags the need for deeper investigation to identify potential errors. So when applicable, also use trend analysis in addition to the 4 validations I covered in the previous slide to ensure accuracy. So my suggested approach to updating spreadsheets is as follows. Number 1, update the titles and period covered first. Number 2, update the recalculation formulas outside the print range. This was the recalculation validation I introduced on a previous slide. 3, update the calculation formulas within the print range. 4, input your updating data. And 5, double check the output. Now, the mistake that some accountants make is they key in the updating data first, and they don't really have a consistent approach to updating the formulas or labels. And again, use the 4 validations I recently covered on a previous slide as applicable. Now, for all the current and future listeners, this is joke number 2. Well, Blake Oliver, one of the creators of the Earmark podcast, was formerly a cellist. And his first girlfriend at college at Northwestern, from what I hear, was also a cellist. But at the end of their freshman year, she actually left Blake for a very accomplished violinist. She made Blake feel like he was playing second fiddle. Going to wait for the laughter to end, and then we'll start in a few seconds back. Okay, back to the SEC reporting content. Key SEC reporting project management areas are: 1, get an early start. For us, we can start on the 10K the day after we filed our Q3 2024 10Q. We don't have to wait for the full year numbers to be finalized. 2, create an SEC reporting calendar that includes the dates the draft document will be distributed, months in advance. This is also known as the multiple turns of the document. 3, create and send out the internal request list early. Typically, where I've worked, there's typically 8 to 12 people, coworkers, who will provide schedules and their information that get incorporated into the 10K. And we want to give them plenty of lead time. Monitor evolving SEC and GAAP requirements, effectively handle review comments, refer to and leverage technical memos generated throughout the year, and more recently, leverage artificial intelligence. And I'll be covering all these areas in future slides. Tactics, getting an early start. As a calendar year-end filer, our 10K submission is slated for Wednesday, February 19th of 2025. Now, our strategic approach prioritizes completing substantial preliminary work by December 31st, 2024. This proactive timeline allots the SEC reporting team more time in January of 25 to prepare key financial schedules, such as the cash flow statement, stock compensation schedules, lease schedules, diluted EPS, etc. Gives us time to manage the internal requests for schedules we receive for 10K integration from those 8 to 12 parties. It allows us to efficiently address the multitude of inquiries from both internal and external audit teams. And by front-loading our efforts, we ensure a more manageable and effective reporting cycle. Next slide. Getting an early start B, rolling forward prior year and quarter documents. Roll forward your prior year documents early. So on the balance sheet, for us, this means our 2023 numbers transition from the current year column to the prior year column. On the income statement and statement of cash flows, the 2023 and 2022 columns move to the right and become the prior year columns, and 2024 becomes the current year column. This concept also conveys to all applicable tables throughout the 10K. Also in the 10K text, when 2022 was formerly the comparative year, this gets replaced by 2023 becoming the comparative year. Now, 10K cloud-based solutions like Merrill, Donnelly, and Workiva have automatic rolling functions from your prior year 10K to your current year 10K. We, at our company, use Merrill, and we love the Merrill compliance tool. And for us, once the SEC reporting project manager rolls the 10K, and that's one of my direct reports, I will go in and tie out all of the prior year 10K numbers to ensure accuracy. And this was completed for us early in December of 24. So helpful hint, it's much easier to tie out the prior year comparative numbers early than waiting till you're extremely busy to do it. And also, while executing the tie out, you may get infused with ideas that actually help improve other areas of the document. And that's one thing I experience often. As I was tying out the prior year numbers in early December, I had a lot of creative thoughts about enhancing certain paragraphs in that draft document. Next slide, getting an early start, tactics. When preparing our 2024 Form 10K, we begin by rolling forward the prior year's 10K, which I mentioned on the previous slide. However, several key updates come from the previously filed 10Q. So our forward-looking statements are refreshed using the latest version of our Q3 24 10Q. Both the description of business and recent trends and outlook sections are updated with information from our Q3 24 10Q. Any reclassifications or newly adopted accounting standards that occurred during the year must be incorporated. Now, specifically for us, ASU 2023-07 segment reporting, improvement to reportable segment disclosures, does become effective for us this year and for calendar year companies in the 2024 Form 10K. So what this means is the prior year segment schedules need to be reconciled with work papers created in Q4 24, as we cannot rely solely on our previous 10K for this information. So in summary, the initial updates do come from our the initial updates to the 2024 10K come from multiple sources. It starts with our prior 10K, our 23 10K. Then we make other updates from our Q3 10Q. Then we look at reclassifications and also consult technical memos drafted throughout the year. Now, an example of a reclassification we recently had was with our fixed asset footnote, where we used to break out our fixed assets into about 8 categories: machinery and equipment, land, buildings, and about 5 others. And we transitioned to breaking them out into approximately 9 categories. So we had to recast the prior year 10Qs and 10Ks to conform to the current year presentation. That's an example of a reclassification. Getting an early start D, adoption of new accounting standards. Well, because of the new ASU 2023-07, this new segment reporting standard, again, we could not merely roll forward our 23 and 22 segment footnote disclosures that we had in our 2023 10K, as these have now expanded and changed. So in November of 24, we finalized our new segment approach to segment reporting. We submitted it to our external auditors and they approved it. And we will be disclosing a more granular segment detail in our upcoming 10K. Now, we prepared the prior year comparative segment work papers in early December 24, capturing the updates. So a helpful hint, and this is going to be a common theme, it's much better to update this early than wait until January or February 24 when we're extremely busy to, number one, finalize the approach, number two, create the new schedule. So again, a lot of the 10K, not all of it, but a lot of it can be completed before you have your final year-end numbers. I'm going to take a sip of tea here. If anybody's wondering what kind of tea I'm drinking, it's green tea. Okay, getting an early start E. What's new in 24 versus 23? Okay, that's something you have to think through in your 10K. For us, we had a multitude of business combinations and asset acquisitions that occurred during 2024, and these were not captured in our 2023 10K. So thus, we initially refer to our Q3 2024 10Q to update these acquisition disclosures in the footnotes and other applicable areas. Then we make other incremental updates for Q4 activity as necessary. We also had a 2024 severance event where a top executive was terminated, and that was not covered in our 2023 10K. It needs updating to the 2024 10K. So helpful hint, again, a recurring theme that merits repeating, at least in my opinion. It's much better to update this early than wait until January 24 or February 24 when we're extremely busy. And, for us, the SEC reporting team has other monthly close duties in addition to just SEC reporting. So we chip away daily, really, and just throughout December 24. So once we hit January of 25, we not only have a lot of our 10K already completed, but we've also thought through a lot of stuff, such as what to include and what not to include in the 10K. And I've had discussions with upper management in certain topic areas. Getting an early start F. The internal PBC requests. Okay, examples of other disclosures that we can 90 to 100% update in December are human capital, cybersecurity, and risk factors. We ask our VP of HR to review our annual human capital disclosures from the 2023 10K and suggest initial updates by November 30th of 24, and then give us final updates by January 3rd, of 2025. And even if this comes in a few days later, it's fine. We have plenty of cushion. We ask our Chief Technology Officer to review the annual cybersecurity disclosures from the 2023 10K and suggest initial updates at the end of November and then final updates in early January of 25. We ask our external counsel to give us early edits to risk factors, exhibits, and forward-looking statements during December 24. So helpful hint, if internal or external contributors don't get enough lead time to fulfill a request, they tend to get annoyed and may complain to your boss and say things like, your urgency is not my emergency. So getting these internal requests out early prevents this from occurring. And we all know that people are going to get on their high horse and rally against us if they don't feel they have enough lead time to fulfill a request, and they're extremely busy when they get the request. Now, most places I've worked, there's always a few coworkers that will lambaste you if they did not get enough lead time to fulfill a request. But the salient message here is to provide plenty of lead time, and I'll get more into that in some future slides as well. Getting an early start G, technical memos drafted throughout the year. Technical accounting memos drafted throughout the year also serve as a valuable source for updating our 10K. These memos can cover various significant events and accounting treatments, including business combinations, executive severance, adoption of new accounting standards, and other stuff. So, helpful hint, it is crucial to systematically review all your technical accounting memos authored during the year to ensure comprehensive coverage and avoid overlooking any material information that needs to be included in the 10K. Now, most of the time, if your technical memo was on a material transaction or event, that's going to get covered in your Qs, but sometimes there's even an incremental disclosure in your 10K. So it's a good idea to review the technical memos authored throughout the year. Getting an early start H, key MD&A information sources. So key sources for the MD&A, that's an acronym for Management Discussion and Analysis. Key sources for that, key sources for the recent trends and outlook and updates to your descriptions of business lines. They can come from your Q3 24 earnings release and your earnings call Q&A. That's usually with the CEO and CFO. Q4 investor conferences, internal town halls that happen in the second half of the year with the CEO and CFO. Management's perspective. The MD&A is supposed to be written through the eyes of management. So gaining insights directly from the company's leadership and reflecting their views and strategic outlook is an effective 10K writing strategy for the MD&A for SEC reporting professionals. So it allows us to align with management's vision, incorporate verbalized philosophies of the CEO and CFO right into our applicable 10K narratives. And it also enhances our SEC reporting team's credibility. The SEC reporting team professionally demonstrates a thorough understanding of the company's position and further direction by using upper management's verbiage when applicable. Getting an early start I. Having generated our initial 10K draft during December of 24, we can complete the majority of the preparation phase of our GAAP and SEC checklist early. Now, this proactive approach ensures that all applicable disclosures are included in the 10K before it's circulated for review, preventing last-minute additions and streamlining the review process. So if you wait too long to execute at least the initial preparation of your GAAP and SEC checklists, you may miss disclosures that get added late after multiple rounds of 10K reviews have already occurred, thereby preventing internal readers the opportunity to add value. External auditors may catch these misses first and ding the company, including the SEC reporting team, for missing required disclosures. So you want all the applicable content to get in the 10K documents that get circulated for review, so multiple reviewers can enhance the content through their review comments. And they can't do this if areas that need to be disclosed are missing. Okay, so that covers getting an early start. It's so important and it's really multifaceted. So I had multiple slides on multiple aspects of this. Now we roll to joke number 3. So when I first graduated from college with an accounting degree, I was unable to land an accounting job right off the bat. So in the interim, I worked 2 part-time jobs. In the morning as a road paver, and in the afternoons at the chicken plant. And the difficult thing about working these 2 jobs in succession was I would return home from work many nights tarred and feathered. And, with the benefit of hindsight, had I worked in the chicken plant in the mornings, then paved roads in the afternoons, I would have been a lot better off. And wait a few more seconds for the laughter to subside out in online land. Moving on to the next slide. Internal requests. For internal requests, clearly define the required deliverables, assign responsibilities to specific contributors, set clear deadlines for submissions, monitor progress and follow up as needed, and update this list for any new requirements each quarter as necessary. Work-life balance. This is something that I've heard Blake Oliver espouse on the accounting podcast. And, it's really important to try to maintain a work-life balance when project managing 10K or 10Q filings. And a helpful hint, if you stay up late one night and deprive yourself of sleep, it could make you vulnerable to errors the next few days. If you plan properly and get that all-important early start, which we just covered in multiple slides, you should be able to work methodically most of the time during the comprehensive SEC reporting project management process. Keeping up with GAAP and SEC disclosure requirements. Staying updated with GAAP and SEC requirements is critical, notably the ones that apply to the 10K or 10Q that you're project managing. So I watch quarterly PwC update CP webinars, listen to PwC technical accounting podcasts, read quarterly Big Four quarterly guides to keep up. I also consult the SEC's financial reporting manual when applicable. Further, I read and listen to SEC comment letter trends and podcasts. And of course, I get the applicable CPE on the Earmark app. That's actually where I get most of my CPE the last few years. Also, as previously mentioned, many of the technical accounting memos authored throughout 2024 are applicable to any new and incremental 24 10K disclosure. So diligent preparation of technical memos during the year serves as a safeguard against unexpected issues, minimizing the likelihood of overlooking critical information in the 10K drafting process. Multiple 10K tables. A. Now, the SEC reporting team prepares many of the 10K tables ourselves, whereas many other 10K tables are provided by internal points of contact. So tables provided by our SEC reporting team, which in my company is 2 people, me and a direct report, include, but are not limited to, the balance sheet, income statement, cash flow statement, equity roll forward, essentially all the financial statements, disaggregated revenue, EBITDA and adjusted EBITDA, that's earnings before interest, taxes, and depreciation, basic and diluted earnings per share, and many more. Now, examples of some tables prepared by others include our billing and collections department prepares our credit loss roll forward, otherwise known as CECL, C-E-C-L. A business line accountant prepares our asset retirement obligation roll forward. A corporate accountant prepares the intangible tables, and another business line accountant prepares the inventory table, etc. So the stuff prepared by my SEC reporting team requires excellent approach to spreadsheet preparation, and review, which I covered in slides 5, 6, and 7. And then the stuff prepared by others requires effective communication and collaboration, notably clear requests and plenty of lead time. Multiple 10K tables. B. For 10K tables prepared by others, it's important that they provide a summary table that is laid out exactly how the table is going to be presented in the 10K. You don't want to waste time hunting and pecking for summary numbers to be disclosed, and even worse, make a mistake. The request for these deliverables should go out early so the providers have plenty of lead time. When schedules arrive, the SEC reporting team needs to provide some level of validation to ensure the numbers received are accurate. If mistakes are caught, kick it back to the provider quickly so they have enough lead time to correct an error. So an example of an error that could occur is, this is a hypothetical example, is if a late adjustment caused our ending inventory balance to be 40 million, but the inventory table that comes in with beginning, work in process, and finished good inventory tied to 41 million, we would realize those two numbers didn't tie, and we kick it back to the person that prepared the inventory table. Now, this is important. It's usually best not to correct someone else's error, rather have them correct it. Sometimes what you think initially is an error is actually not an error when you clarify and confirm with your applicable point in contact. And if you convert something that's actually accurate into a mistake, that's not good. Terms of the document. For us, the evolving 10Ks are scheduled to be distributed on the following dates. Draft 1 went to our Chief Accounting Officer on Monday, December 2nd of 24, with review comments due by Friday, December 20th of 2024. Here, we want to apprise the Chief Accounting Officer of the new disclosures for 24 versus 23 and collectively get off to an early start. And for us, the CAO is also copied as we make 10K updates between December 2nd and December 20th. Draft 2 goes to a smaller group, including our CFO on Monday, January 13th of 25, with review comments due Wednesday, January 15th of 25. Draft 3 goes to a larger group on Friday, January 17th, and includes most of the numbers populated after our first accounting close, with the review comments due Tuesday, January 21 of 2025. So this is the first time we can really finalize the first draft of our 2024 versus 2023 MD&A comparisons, because that's all populated. This also is the first time our external auditors get a draft, I believe. Terms of the document B. Draft 4 goes out Wednesday, January 22nd, with review comments due Monday, January 27th. And here's a note. Not everyone internal who receives the 10K drafts provide review comments on each turn, but about half do. Our disclosure committee meeting is scheduled for Thursday, January 23rd. This includes the SEC reporting team, but also includes our CEO, CFO, Chief Accounting Officer, Chief Technology Officer, General Counsel, Director of Internal Audit, segment leaders, Director of Tax, and maybe a few others. And I lead this meeting along with our Chief Accounting Officer. So note, the disclosure committee agenda sent to each disclosure committee member is designed to answer most questions that would have arisen during the meeting, so everyone is versed on the main topics to be discussed. We don't want to introduce any big topics for the first time at the disclosure committee meeting. Draft 5 goes out Friday, January 31st, with review comments due Wednesday, February 5th. This draft includes the tax provision. By this draft, we hope the numbers are final, other than numbers that are not available until closer to the filing, like number of shares we have outstanding a few days before we file, and all key disclosures are populated. Note, by the time the 10K draft goes to the board of directors, the numbers should be mostly tied out and all key disclosures should be populated. Big changes that occur after the board receives their 10K copy are usually not good in terms of the SEC reporting team's performance. Now, I was once at a company, this is many years ago, where division made a large post-close adjustment after the board had received their 10K copy, which increased cost of goods sold by millions due to a mistake in the conversion of inventory to cost of goods sold that I believe the auditors found, and incentive compensation had to be completely redone, and the board was not happy. So for us, everything within our control, we want that document to be close to final once the board gets their draft. Terms of the document C. Draft 6 goes out Friday, February 7th, with the review comments due Wednesday, February 12th. This includes comments from the board of directors, and at this point, only minor edits should be made. Making big changes at this stage could indicate that the project management of the 10K process is not effective. And the exception would be if we had a big subsequent event. We're going to file our 10K Wednesday, February 19th. Between February 7th and February 19th, although there could be lots of activity in addressing auditor questions on the ledger or auditor questions about internal controls, there should be minimal updates to the 10K unless something compelling occurs in Q1 of 25, necessitating a subsequent event disclosure. Okay, here's joke number 4, and I will try to make sure I give everyone enough time to finish off their laughter before I get back into the content. So I've worked at corporate America for the past 30 years, and one slogan I hear a top executive pontificate every year is they say we have too many silos. We need to break down these silos and communicate more effectively. You want to know what's interesting? I have a sizable investment in a farming business, and our biggest problem is that we don't have enough silos. That's right, down at the farm, even though our communication and coordination is good, our grain went bad. That's right, lack of silos goes completely against the grain. Give a few more seconds for the laughter. Okay, next slide, handling 10K review comments. One of the critical success factors to effectively project managing the SEC reporting process is to effectively handle review comments. A few notes as follows. Individuals who invest time to provide review comments often have an emotional connection with their feedback. If their comments are mishandled, it can lead to frustration. You definitely want to avoid upsetting a segment president, general counsel, CFO, etc., that takes the time to provide 10K review comments. So effectively managing the review comments fosters a collaborative environment where team members feel encouraged to share their insights and expertise, ultimately leading to a more effective SEC reporting process. Handling review comments B. My suggested tactics with handling review comments are as follows. If any review comments are vague, immediately clarify and confirm what the commenter meant. If you speculate, you will often be wrong. If there are conflicting review comments, an example would be both the CFO and general counsel comments on the exact same section with conflicting suggested edits, immediately indicate there's a conflict and have the parties, in this example, the CFO and general counsel, decide whose suggested edit should survive. Have a system to ensure that you have captured each review comment and double check to ensure each applicable review comment is updated properly in the 10K draft. Helpful hint, effectively handling review comments is really a team effort. And I recommend at least 2 people being involved with this effort. Helpful hint, again, you can be effective at technical accounting, SEC reporting, good at attaining accuracy with your tables, a good writer. But if you fumble review comments, you can appear as disorganized and ineffective. Helpful hints, some review comments may need to be rejected for various reasons, but it's a good practice to communicate the rationale behind not utilizing these comments and suggestions to the commenter, or they may feel slighted. Because again, people that provide review comments often have an emotional connection to their comments. Handling review comments C. Lawyers can be vague. Internal and external counsel often have comments and questions that appear inapplicable or erroneous on the surface, but are germane when better understood. So I recommend clarifying and confirming to ensure understanding with all comments and addressing all lawyer questions to ensure completeness. And fumbling a lawyer comment can trigger noncompliance with a section of the 10K and bring about the wrath of the general counsel. And none of us want that. Handling a review comment summary. Consider creating a dedicated binder for tracking review comments. Validate all updates from review comments through printed drafts for accuracy. Seek clarifications for vague comments promptly. Address conflicting comments immediately. Inform reviewers about rejected comments when applicable. And use a team approach with at least 2 people involved, that ensuring that all applicable review comments get properly incorporated into updating the 10K. Joke 5. Back when I was single, I've been married 21 years, but back when I was single, I once dated a female graffiti artist for 18 blissful months, and then suddenly she dumped me. It was a complete shock, and I never saw it coming until I started reflecting back for clues, and then I realized that all along, the writing was on the wall. Going to wait a few more seconds for the laughter to subside from the current and future people listening to this. Thank you for the laughter. Develop effective writing philosophies for SEC documents. Clear, concise writing ensures better readability and compliance. Avoid jargon, prioritize the active voice, and maintain consistency in terminology to enhance the quality of SEC filings. Now, in 24 and 25 and thereafter, applications like Grammarly, ChatGPT, and other AI systems can help with this endeavor. Helpful hints, examples of review comments I received. Now, these are review comments I received, I think, like in 2008, years ago, but the concepts still are applicable today. It's normally best to use fewer words to communicate the same thing. I had a sentence that read, the banking syndicate decided to forego the excess cash flow requirement. And the superior way to write this, which I updated through a review comment, was the banking syndicate waived the excess cash flow requirement. So, so we converted from 3 words to 1 word, said the same thing. Subpar, the potential maximum contingent liability is $100 million. Superior, the maximum contingent liability is $100 million. Again, less words to say the same thing. Another helpful hint is don't be negative if you don't have to. Seeing an example below. Operating income earned by the ABC joint venture benefits net income attributable to the ABC company by only our 51% ownership of the joint venture. And the superior way to say it is drop the word only. Operating income earned by the ABC joint venture benefits net income attributable to the ABC company by our 50% ownership joint venture. So these are a few comments I've received in the past, and they hopefully, and I believe, convey germane thoughts. Properly defined acronyms, also known as deferred defined terms, and refer to the right footnotes on the references. On 10Ks, acronyms should be defined both in the notes to the financial statements and again in the MD&A. If not using artificial intelligence, I suggest scheduling it out all defined acronyms on an Excel schedule and showing the page number where the acronym is initially defined, then checking all acronyms in the document to ensure that it was previously and properly defined. And assuming approved security measures within your company, AI can actually analyze a relevant 10K section and verify that all your defined terms and acronyms are properly defined, and identify potential issues where you didn't define it. This also is the case with footnotes. You want to make sure you refer to the correct note number. And as the document is edited and revised, keep in mind that the location of the defined terms may need to change, or a footnote reference may need to change if you add or remove a footnote. So again, if you're not using artificial intelligence, I suggest an actual system for doing this, like actual scheduling it out in Excel. If you're using artificial intelligence, you could, literally just copy all your footnotes in, and maybe you could do it without numbers, and you could just ask it, did I refer to all the correct footnotes, and did I properly define all my acronyms? And if it didn't, it would tell you right away. That's another way to do it in these times. Next slide, the importance of the tie-out process A. The tie-out process verifies that all numbers in the SEC filing against source documents. It's critical for ensuring accuracy, building credibility, and minimizing auditor review comments. Our approach to the tie-out is I tied out all our prior period numbers earlier in December of 24, which I mentioned earlier. We next tie out all the numbers that are deemed final following the January 17th update. And we tie out all numbers that are final starting January 31st, and that's after our tax provision gets booked. And we also have separate prepare and reviewer sign-off. So we have a preparation and a review for each tie-out. So at least two people. Then we actually have junior staff review our tie-out to ensure that throughout the entire document after the SEC reporting team finishes preparation and review. So we take our tie-out seriously, and it's multifaceted. Preparation of the MD&A. MD&A sections typically involve contributions from the FP&A team, that's financial planning and analysis, investor relations, if it's separate from the FP&A team, segment leaders, and the CFO. So proactively engage these key stakeholders to gather comprehensive and relevant information for a thorough analysis is necessary. And here's the tip. If you have MD&A meetings with segment leaders, send your list of questions at least a day before the meeting. That way, they're more likely to be prepared with answers to all your questions and won't respond with, I need to check with my team. And again, that's the same concept of providing lead time. Managing the intense 2 to 4 week period. So 10Q and 10K filings typically include a continuous period of 2 to 4 successive weeks where it's easy to get overwhelmed and thus require heightened focus. So prepare for an influx of review comments from various stakeholders that comes in waves. Prepare for a multitude of inquiries from auditors that can come in waves. And your regular work task workload could increase. So I recommend approaching this methodically, address each item individually for accuracy, finalize all sections, resolve review comments, conduct thorough quality checks, maintain patience and attention to detail throughout this critical period. And it's very helpful to have a predefined management workflow and tactics for this, like is involved in this. Presentation also, it's really important to get an early start and knock out as much as you can early. AI use cases. So artificial intelligence tools can enhance efficiency and effectiveness in SEC reporting. They can assist with drafting narratives, identifying inconsistencies, improving grammar and style for clearer communication. So as I mentioned before, AI can help ensuring all acronyms are properly defined and all footnote references are accurate and consistent. You can ask AI to make any paragraph or sections read more clearly, concisely, and consistently. You can ask AI to identify spelling and grammatical errors. AI knows Excel formulas for supporting schedules such as diluted EPS. It might use advanced Excel formulas. For me, when I needed an advanced Excel formula, if I couldn't write it myself, I used to consult Excel experts. Now I can get it from Perplexity or ChatGPT, and they work, and it's very helpful. Here's an AI use case that actually happened. So I used ChatGPT to enhance a business line description. It was one paragraph, transforming it from factual to strategic and factual. So the AI quickly generated content that, with minor follow-up edits, significantly improved a business line's narrative strategic tone. And this was a business line that was small but had grown through acquisitions. This process reduced what formerly would have been a few hours of work to a few minutes, earning praise from the business line VP, who was impressed with the update and approved the business line description. Helpful hint, AI sometimes provides outputs that don't fit what you're looking for, so ensure to scrutinize any outputs you get. Next slide, one preparer, two reviewers. Some financial schedules carry an inherently higher risk of material error, warranting a more rigorous review process. For these critical errors, I recommend implementing a one preparer and two reviewer approach. We do this with things like the statement of cash flows, stock-based compensation expense, and weighted average and dilutive share calculations. The additional scrutiny minimizes the risk of material misstatement and ensures accuracy of our complex financial calculations. XBRL tagging. I think most companies outsource XBRL tagging to their SEC compliance solution companies like Merrill, Donnelly, and Workiva. But it's important to review the tagging for errors, as we do find a few tags, typically each quarter, needing correction. A few notes as follows. It's our experience that most corrections from XBRL tags come from new disclosures. So for us, our segment disclosure this quarter or this year end is going to be new with more stuff disclosed. So we're going to put extra focus on those XBRL tags on our expanded segment footnote. Now, an example of a tag we recently corrected was that our third party had used a weighted average interest rate XBRL tag, where the number being XBRL tag was actually for a period end interest rate. So we corrected the tag prior to filing, but that's the type of example you can get for XBRL. So next slide. Final thoughts. This is the last slide. If you like the SEC reporting content presented, please share it with the Earmark podcast and CPE team. Also, if you like my intermittent jokes, you may enjoy the clean stand-up comedy documentary movie called From Accounting to Comedy Sniff at www.atcsniff.com. I repeat, www.atcsniff.com. And if you want to see me present a new corporate accounting CPE topic again with both great content and perhaps a mix of world-class jokes, be sure and let the Earmark people know. Thank you, everybody, for listening. I hope you enjoyed it, and I hope there's things I presented that you can present or you can implement right away in accounting. And of course, also hope you got a few laughs.
Today's event has ended. To earn CPE, go to earmark.app or scan the QR code on the screen. Then log in or create your free account. Search for the course by tapping on the magnifying glass icon on the home screen and then entering the name of this event. It takes a few days to make the course, so if you're attending this event live, keep an eye out for an email letting you know when the course is available. Pass the quiz to earn your CPE, then tap the button to email yourself a certificate. Stay tuned for more events from Earmark. Thanks for joining us, and we hope to see you again soon.